I generally refer it to as corporate finance. Why? Because the name has changed now. Okay, in last 2 years. Otherwise, it is corporate finance only from real world perspective also, and at the same time, topic wise also historically it has been called corporate finance. Okay, corporate issuers weightage, exam weightage 6 to 9%. Okay, and even though exam weightage is less, okay, again, no point in repeating the same story. Needless of the weightage, it goes without saying that you need to be looking to score entire marks. 6 to 9% means roughly we are talking about how much questions? 15 to 18 questions, right? Now, most important or very important from a real world perspective, why? All the subjects are important. What is the significance of this subject? Right? This subject talks about where the money is coming from, right? Where the money is getting invested, and how the money is being used on a day-to-day basis. Right? So these three aspects are being discussed or addressed as far as this particular topic is concerned. Where the money is coming from, like how do I raise the money, how do I invest the money, where to invest the money, and how do I utilize this money on a day-to-day basis. Right? That is what this entire corporate finance is about. Now, given your syllabus, right, they have actually brought down the content from the calculation perspective. More it is from subject which needs to be studied and understood. Right? More of concepts, less of calculation. Right? Most of the calculations revolves around investing and raising money. Okay, most of the calculations revolves around investing and raising money. Now, all of you are already aware of time value of money, right? So more of that will get applied as far as whatever we are discussing. But this as a chapter, as I said, it discusses, right, the funding part, the investing part, right? The nitty-gritty is revolving around that, apart from calculation also. Okay, apart from calculation also. Now, the subject or the topic which you are going to study today is your, I think, 4th or 5th module within corporate issuers, right? What is the first module in the corporate issuers? Organization, first one, then corporate governance. Then 4th, 5th, 6th. So 6th is what we are going to do now. Okay, working capital. Probably if we have time, I will start today, or we will do it in the next class. The first 4 chapters, right, you will do by yourself. This is something which you have seen in your 12th standard and in your college also, right? Corporate governance you wouldn't have seen, but more of theoretical content, right? Self-explanatory, but important. It is not that questions are not going to come. Questions are going to come, right? It will be full of lectures only if I keep doing it, right? So you will do by yourself. And if you have any difficulties, you can bring up, I can explain. Okay, so the first module that we are going to see is about capital allocation and capital investment, right? Okay, so we'll take one example directly. All of you know that time value of money is, I mean, you already know about time value of money, right? So let us take one question where, what is the subject about? The subject is about investing and the subject is about raising money. So the first aspect that we are going to discuss now is how to invest or where to invest. This is not investing in equities. This is investing in projects, right? So you are investing money. This is more from a business perspective, right? Not about investing money in equities. We are not trying to analyze that. That is discussed in your equity section, right? We are not talking about discussing in bonds or fixed income. That is discussed in your other section, fixed income, right? Not about cryptos or real estate. That is discussed in your AI, right? So here we are talking about investing in specific business related projects which the company is going to invest. How do they evaluate that investment financially? Right, from a financial standpoint, we are looking at it. Right, this is more so your project finance and your financial modeling which you have done. right? So project finance aspect of your financial modeling and also DCF valuation also. Okay, so now let's say we are talking about a project where I'm investing in a business related project. So when I'm investing in a business related project, there is some investment that has to be done, and then there is some revenue that is coming, right? So how do I evaluate these two, right? The first section or is about initial investment, right? So I'm doing the investment, right? I'm investing money, then I'm making some revenue, I'm incurring certain variable cost, I'm incurring certain fixed cost, right? There is certain working capital, tax rate is there, and then project life is there. How much? How many years? 5 years. So that means this project I'm investing today for so much, right? So much revenue I'm going to get, so much variable cost I'm going to get, so much fixed cost I'm going to get, right? Calculate the cash flows over next 5 years. First, you only calculate the cash flows. Okay, not asking you to evaluate. First, calculate the cash flows for 5 years quickly. Simple addition, multiplication, subtraction. See, so initial investment is 800,000. Now, to run the business, let's say I've set up the office. I've set up let's say manufacturing. Let's talk about manufacturing because we're talking about fixed cost, variable cost, and all. Because we are talking about variable cost manufacturing. So I've set up the factory, initial investment. Okay. Then how will you earn revenue from that? Initial investment done, factory is ready, machines are ready. After that, what happens? Production. Where will the production? So for production, what do you need? Raw material. So for raw material, how do you get the raw material? Supplier. Supplier is who? Your grandfather. Then so you need money for raw material. My grandfather is not sitting there. My uncle is not sitting there. Then your grandfather is sitting. No, your grandfather will give. So for that money, where will that money come from? That money also you have to put, right? That money is nothing but working capital. Right? So working capital is also investment, right? Even though it keeps rotating, but you have to invest that money. Right? So my initial investment is how much? Minus 800 minus 90,000. Right? Then now T1. How do you calculate T1? How much is revenue? 1.6 million. Then minus 1.1. Then minus 160. So net is how much? 340. So that is your cash flow. Who will pay tax? And then again my grand, he will not pay. I have to pay. So 340 into 0.7, which is how much? 238. So you got 175. Who got 175?
I subtracted the working capital.
Working capital. Okay. Tax did you calculate? Right. Okay. So T1 is how much? 238. Okay. So this T1 to T5. Correct? Because we are not talking, we are assuming that revenue is going to be like this, profits are going to be like this for next 5 years, right? Okay. So these are the cash flows. Now in T5, if we have project life is 5 years, at the end of the 5 years, if there is a value for the factory, to sell the factory, to sell the machines, then we can use that value also. In T5, what will happen? One more cash flow will come. Which one? Working capital will come. Right? Because we are closing the project, that working capital gets released. Okay, these are the cash flows. These are the cash flows. Now you have to calculate what? NPV. Calculate quickly. Required rate of return is 10%. Okay, assume there is a scrap value of this factory in T5 for 40,000. Okay, scrap value is 40,000. Quickly calculate the 10%.
There's 2%.
Where?
Put G 21%.
Sorry. What is not correct?
So the first year cash flow is 238.
Okay. So cash flows 890, 238, and fifth year cash flow 368. Okay, discounting factor. All of you have done this. But I told you to do manually also. Calculating the present value of the future cash flows. These are the cash flows in the various years. Appropriate discounting factor at discounting rate of 10%. Then discounted cash flow. This you should be very much comfortable in doing with ease. Okay. And in the calculator, do we know how to do it? Cash flow calculation. Right? Anyone has any doubt? This is the way it needs to be done. Right? So cash flow function, first cash flow, 2, 3, 4, 5. Okay, there is no 6. I think there was a different assumption which I took earlier. Plus CPT plus NPV, IY will be given, then press compute. Now, this is the only way to do in the calculator, or there is another way also to do it? So how did you do it in the calculator? Quickly tell. Sure. There is easier way also to do. Which one? Calculator, there is like after you do this CO1, right? Then after you press this down arrow, what do you get? F01 frequency. So there, what do you give? 4. That is what I was asking. Frequency you have to give 4. Right? So then you don't have to enter 5 times. Okay. Second cash flow. First year, when you enter the first cash flow, CFO minus 890, that is fine. CO1 will be 238. Frequency of that will be 4. CO2 will be 368. Frequency of that will be 1. Right? So basically, quickly to save time, you can do so. At the practice stage, you can practice. In the exam, you do like this only. Okay. It will take 10 seconds extra, which is okay. Okay. Now, so you have arrived at calculation of, okay, NPV. IRR. Compute IRR quickly. Your calculator, the next is IRR, right? 13.76%. Okay. Which is also okay. Okay, IRR is 13.76%. Now, what is IRR? What is it? Okay, that is a mathematical outcome. But what does it mean exactly?
Expect from the project. Money is reinvested at the rate.
Basically, this is the rate because you are not taking back this cash flow, right? That is the assumption. The assumption is you will not take this cash flow. It is reinvested. That is the assumption. In your NPV calculation, in your time value calculation, it is reinvested. In fixed income also, you have seen that bond, right? Cash flows, zero coupon bond, we do compounding. The assumption is even though you don't get the cash flow, the assumption is it is reinvested. And in case of coupons also, when you get the coupons, these coupons are also reinvested. Right? These coupons are also reinvested. Who are them? The coupons are reinvested at the what rate? Required rate of return. At the yield, effective yield, which is your IRR. Right? So, here in NPV calculation also, this is assumed that the cash flows are reinvested at IRR. It is very, very important that you understand this aspect. This is very, very fundamental concept. NPV IRR concept, very, very fundamental concept. Okay. So these cash flows that are coming, they are invested or reinvested at IRR. Okay, that is the assumption. Now, if I put my discounting factor to be 15%, what happens now? NPV is negative. Now, what happens to IRR? What happens to the IRR now? So that means IRR will continue to be 13.76%. Now, what is the correlation between these two then?
Cost we have put is more than the IRR.
No. What does this mean now? If my discounting rate goes up, I think we have seen this in fixed income also. In what bond calculation? It's same. Par bond, premium bond, discount bond, same. Now what happens? Now what happens? And if I put right, so think and tell me what is the impact of this? I can invest in this project or not? That is the idea, right? So when I am doing so, these are my cash flows. When I am calculating the present value at a given discount rate, right? When I'm calculating the present value at a given discount rate, these are the present values, right? That means I'm telling my required rate of return is 15%, and the present value of these cash flows are like this. Net, this is the present value. That means when I'm investing so much, my present value becomes so much, right? That means now we are trying to evaluate whether I can invest in this project or not. Trying to evaluate whether I can invest in this project or not. So if I invest in this project, what happens? Negative net. This number is received when? This 275 is received when? How much do you receive? At the end of 5 years?
A loss of 27.
554. You're receiving negative 27,554 at the end of the project.
Yeah, no, you receive more than 30. So your total cash flows.
Then what is this number? This is not something which you will receive. This is also not something you will receive. You are receiving every year, you are receiving 238, 238, 238. At the end of the 6th year, this is the number you will receive. This is the present value of all these cash flows. This is the present value of this 238. This is the present value of this 368. Are you getting my point? This is the present value. This is the present value. This is the present value of these various different numbers. Right? So, we have to understand that even though the assumption is it is reinvested at IRR, right? But this is an independent number of the project. This is my required rate of return. So, a certain investment, for example, I may have utility of this asset, right? You may have a different utility from the same asset. You may want to buy it, you may not want to buy it. I may want to buy it, I may not want to buy it. Both may have a different decision. Project is same. Project is same, cash flows are same. Your requirement is 8%, your requirement is 10%. You may go ahead with the project. My requirement is 20%, I may not go ahead with the project. This you have to understand. Right? So your NPV is directly a function of what? Discount factor. Your NPV is also a function of what? Cash flows. Your NPV is also a function of timing. Right? It is a function of all these inputs. NPV will be impacted by all the inputs. That means my NPV will be impacted by initial investment also. If I change the initial investment, my NPV will change. If I change the initial investment, my NPV will change. If I change any, let's say, revenue assumption, instead of 1.6 million, I put 1.5 million or 1.7 million, my NPV will change. My cost, if I change the cost, my NPV will change. Any factor I change, it will change. Instead of in the first year, I'm getting 238. Let's say I may not get anything in the first year. And in the second year, I may get 4, how much? 76. Still, there's an impact on the NPV, right? Are we getting this? So your NPV is a factor of all the numbers. NPV is a factor of all the numbers. Able to understand? All these numbers will impact life also. Instead of 5 years, if it is 6 years, will the NPV change? NPV will change. Right? Tax rate, it will change. Able to understand? This impact that we understand will come only when you do this manually, not using your calculator. Okay, understood? NPV. NPV is what? Net present value of all the future cash flows. Okay. Now IRR, as IRR changed, we did lot of changes here, right? With respect to the discount rate, did IRR change? IRR is purely a function of the cash flows and the timing, right? So yes, all these things will have an impact on the IRR also. Except required rate, everything else will have an impact on the IRR also. Now IRR is what? IRR is the rate at which the cash flows are giving return internally, right? 13.76%. My required rate is 10%. So if IRR is more, I can accept the project, right? Same thing you can refer to your bond also, coupon rate and yield. Right? Something, a correlation you can draw between coupon rate and yield. Now, NPV is what? NPV is an absolute number, IRR is a percentage. Which one should I go with? Should I go with NPV or should I go with IRR? I should go with NPV. Why? Because it is an absolute measure. Okay, we'll see some more points with reference to NPV. So I hope calculator also make sure you understand how to do this, right? And manual calculation you will not be required to do in the exam, but to understand the concept, you should know this. Okay, you should be able to draw this table very, very quickly. It is not a big deal. You should do like 2-3 times. You do it, right? You can do it in Excel. You can do it in your notebook. The best thing is to do it in your notebook using a manual calculator, right? Then it becomes very, very effective in terms of understanding. Okay. Now, what is NPV? Basically, it is based on cash flows, right? Not based on the profits. Even though you calculated profits, you calculated the cash flows. We did not use depreciation in this. Looking only at cash flows. Okay, time period, it is absolute number. How much the stakeholder is becoming wealthier by. Right? That means if I do this, if I enter into the project, my wealth will increase by so much. This is an absolute number.
I mean, DR and IRR has a no correlation.
No correlation. R is your rate. Whatever you want, you can put as R. And then use the discounting. Okay, this is purely from a financial perspective we are trying to evaluate. But projects are not decided purely on financial basis. There are other bases also. Okay, now let us understand more about how this the investment analysis is done.